I've got two questions for you, Mark. Firstly, how do you explain these products to your customers? What depth do you go into with your private clients? And secondly, you're in charge of alternatives and the plain vanilla, if we can call them that mutual funds as well. How have you expanded your due diligence programs to include the ETFs and the exchange traded products together with these other strategies we've been talking about that have that you might need a very different approach to looking under the bonnet?
I'll start with your second question first, and that's with how do you do the due diligence. I think we're able to take a lot of lessons learned from the hedge fund due diligence process and to actually use that in the long only world. And more plain vanilla slash UCITS funds are going to need more and more due diligence being done them, looking at the directors, looking at the pricing, looking at the strategy, how they execute, which I think in many cases a lot of advisors or investors have shunned simply because of the UCITS stamp on it. But if you look at sort of the range of products, I think going forward, I think in an ideal world, what you'd see is some sort of a bifurcation in terms of allocation and strategy, whereby you would have passive allocations to benchmarks, and then you would what one would call cheap beta, and then probably maybe a little bit more expensive alpha through the use of boutiques, alternative strategies, and not going down the benchmark hugging route. Why do you need to do that? It's because I think it starts to become very difficult in today's world when you try to explain to a client why a certain fund has underperformed a benchmark, when they can say, well, I've hired you, I pay you an advisory fee, you're picking funds for me which are underperforming the benchmark. Well, I could pick the benchmark myself for a few basis points and execution costs, and I don't need you. So this differentiating factor that advisors need to start to demonstrate towards their clients is becoming more and more valid, I think. But that comes down also to education and training. And again, we see different levels of understanding and interpretation in different countries, that there is no one solution for each country, and one is sometimes based on local market factors due to taxation or otherwise, and on the other hand, it could be because of local presence in the market of another provider who just happened to have told an advisor how good or how bad his product is or someone else's is, and that's what stays in someone's head, unfortunately. So I think maybe a bit more fundamental training education is needed. But again, nowadays advisors are more about client retention than necessarily learning about new products, and that's the challenge we face in terms of getting enough airtime to educate.
And I'll tell you one thing, I saw recently some very big private wealth managers, 3 were US and 1 was UK, and their presentations to a client. Now it was interesting, the 3 US, and some of them were, I was astonished because they're very, very big kind of companies, very big, and the portfolios almost seemed to be identical. They were mainly ETFs, apart from a large allocation to hedge funds. So they had typically 10 or 15% in a fund of fund hedge funds, and the rest from ETFs. The UK company doing the same thing had it, if you like, the old-fashioned way. And when you actually work through the cost varied from top to bottom. Actually, the cost varied between about 1.5% all in to 3% plus all in. And it's interesting when we were talking about this earlier, in terms of hedge fund returns and a simple index strategy. Actually, I think you could get much higher return than that 10% allocation from hedge funds by actually doing it in a kind of smarter way of investing via ETFs with a split of bonds and equities. But it's interesting, the US, and these were big, big companies in the US with UK centres, where they kind of tell everybody every day how they got these huge research departments and these thousands of analysts, and in the end they were buying a very well-known kind of household name, and it wasn't Vanguard actually, kind of ETF. So the ETF diversity wasn't huge, and it was just ETFs.
Eric Verleyen, you specialise on the advisory side in fast investment decisions. Are there such ideas currently which are particularly suited to the use of ETFs?
I think, as it was mentioned before, we like to use ETF maybe to take some rapid decision on our asset allocation. And if we do so, it's more about gaining some beta than alpha. So I'm not really talking about specific strategy. Sometimes we do use some ETF to get some sectorial exposure. This is a way to create some alpha in the way we construct the portfolio. Otherwise, we tend not to use them for bonds or corporate bonds, where we prefer actually to select some names. But definitely, they are part of our asset allocation. Yeah.
And if we can, I'm afraid we're drawing towards that the concluding time, and I know our chefs next door are cooking up a few delicacies for us, and they're very keen to share them with us. But if we can just all briefly make some very quick valedictory remarks about how you expect the market the ETF market to develop in the wealth management space in the next couple of years. Mark, if we start with you.
I do think the industry will grow within the private wealth management space. However, I think this is predicated on several issues first. First of all, we see a change in business models, as I mentioned before, the arrival of RDR. That's going to be affecting the proposition that is brought forward to clients. I think it's going to be an issue on fees. There's going to be transparency. What is transparency? Can the end investor use it? Is it to their benefit? Or is this transparency at the sort of the product manager level? And also understanding what an ETF is. Is it smart beta? Is it just index exposure? Or is it taking a managed fund and putting it onto a stock exchange? And I think this confusion is not beneficial, and I think some of the terms used by us probably need to be better defined going forward.
We still view them as access vehicles that have got their role in portfolio construction and advice. There's no hard and fast 50% threshold that we must have or not have in portfolios. Each market, each opportunity is judged on its own merits. In terms of their growth, I actually think that as RDR spreads across Europe and maybe to Asia, I think one of the powerful factors in their favour will start to diminish. But at the moment, active management is working, whether it's a factor, say size is working in favour of active managers or not. And I think that also predicates against the acceleration of growth of ETFs. I'm sure that will change at some point in the cycle. But what I would like to see is in Europe is a much greater transparency and visibility and the capturing of off-exchange information and data, which would help us as selectors and implementers be able to make better and informed choices.
Yeah, I think I echo what my colleagues have said in that I think the industry is set to grow. I think there are a few factors to it. Certainly, it has proved a resilient product and a resilient industry in that over the last few years, with a lot of headwinds from markets, from the physical synthetic debates and other factors within the product, you've actually seen it's one of the few financial products that has actually managed to continue to grow its AUM and its adoption by users. So I think if market conditions are improving, I think that's one of the factors that goes away, but also the cost and RDR and regulation are in the ETF's favor. I think the range of products that is available through ETFs is growing, and by that there are more users and more uses for the product in different areas. So overall, I think that it's proven itself to be an efficient wrapper. It's an efficient product and an enabler. If that's, I would put that on my good feature slide. And I think the growth is set to continue.
I mean, I will share this. ETF is a wrapper on which there has been a transparency focus, and I think it's actually pushing the price down on fund management. Going forward, because it is very popular, I think there would be more and more active strategy within the ETF, and I think fund managers are trying to leverage actually on the ETF space and coming into that space. At the moment, we're still talking about, as we mentioned before, indexing, non-indexing, when we talk about ETF. Very soon, I think it's going to be a mix of everything, and we will realize that it's just a wrapper at the end, which is more transparent.
Hard to add anything and just say highly likely to grow with lower fees.
I mean, personally, the fees will be much more important going forward than probably they have been in the recent past. Because if you think about it, most investors' memory, by definition, is kind of shorter term. So the returns from large asset categories last year were probably unrepeatable on a medium to long-term basis. If you look at the long-term return of equities from 1900 to 2013, it's 5.4% per annum real. Now, if you think the average from end-to-end investment chain, including the active funds or the index funds, is about 3% per annum, you can see it's actually eating about 60% of the underlying return. So when you get a more focus on the whole chain rather than just the advisor part or the platform part or the investment part, that's when if you like, the advantages that ETF offer in that you can bypass large elements will come into their own. At the moment, you still have, the fact that only a week ago you have one huge UK company saying how we're actually making a big focus. They're not going to talk about annual management charge. They're going to talk about the ongoing charge. Well, I thought all the companies were meant to do that for the last few years. The fact that you have the largest platform in the UK talking about the annual management charge of its Wealth 150 list shows actually in people's minds there's still a long way to go to actually add up all the costs, add up that 3% and compare that with your long-term returns of, as I said, 5 to 6%.
Absolutely right. I think we're still going through huge amounts of change, and from being part of the Spider team that launched 21 years ago what is effectively the industry today, it's amazing to me how the innovation of the industry continues, and that some of the key tenets that drove the interest in ETFs back then are still the factors today. So we're talking a lot about cost. Well, let's face it, so the ETF has a place to play, and there's a reason why it has afforded investors the opportunities it has. Liquidity, we've talked a lot about that today, and then transparency, same thing. But though each of those tenets have migrated in terms of the reasons or the uses behind ETFs and certainly investors' knowledge base, I don't think that's going to change. I think the sustainability of the industry is here to stay. I would say, though, that we're still tiny in relative terms to mutual funds and other sort of the financial services industry as a whole. And it's remarkable to me just what impact it has had in a very relatively short period of time within the history of financial products in the market. And so for that, I think I applaud the industry, and I think it's phenomenal. And the uses and the investor base, it is one of the few products where pretty much any investor has access to this. And I think that is part of the innovation and the beauty of that product, which has made it so successful. So I think we'll be here in 21 years' time talking about some of the same tenets that we talked about 21 years ago, and there'll be some new uses and new investors that will just, we'll look back and say that's crazy that we didn't see that in 2014.
So thank you very, very much to all of you, and please join us for our lunch. Thank you.